Greenlam Industries operationally seem to be a weak quarter for Greenlam. Weakness seen across most parameters and segments. Let's discuss the factors responsible for the same and what's the outlook ahead like with Saurabh Mittal. He's the MD and CEO of Greenlam, and I think the headline says it all. It's been a flaky quarter. Saurabh, good having you. Thanks so much for joining in. Was this on expected lines, or were you as well maybe slightly disappointed with how the quarters turned out?
Well, actually, if you look at the quarter on a GST adjusted basis, the revenues are at nearly 9-10% kind of a growth level. Gross margins are higher than the previous year's quarter. We've had a little bit of higher expenses, which is kind of showing up in the weak or a slightly lower EBITDA numbers. From a working capital cycle perspective also, we've been quite flattish. We've rather been able to improve by a day. Markets have been challenging. Costs have gone up of raw materials in the last quarter. So if you look at the entire parameters in terms of raw material cost structure, market condition, our ability to manage the working capital cycle, I think it's been a fairly decent quarter. Yes, obviously revenues could have been slightly higher, but on a GST adjusted basis, seeing the market scenario, we had a 8-9% kind of top line growth, which is reasonably good, I think.
Okay, let me try and focus on some things that I thought looked a bit off, and tell me what you thought of that. I mean, I'm just looking at the average realizations per sheet, whether in laminates or in decorative veneers. Maybe laminates it stayed flat, but in decorative veneers it seems to have come off from FY18 or FY17. Why has this happened?
It has, yes, it has. If you see the veneer business actually degrew in the last quarter. We had an excellent quarter 3, but in quarter 4 we had a slight degrowth, which also resulted in lower volumes and lower price realizations, which in fact also resulted in a lower EBITDA margins. In veneers in quarter 3, we had an EBITDA margin of nearly 22%. In the last quarter, we ended up with a 19.5% kind of EBITDA margin. Although the flooring and the door business, which also falls under the overall veneer and allied categories, they grew reasonably well in quarter 4, and we've been able to reduce our losses in the door and the floor business. But the mainline veneer category did degrow in quarter 4.
So why is this happening? The reason why I also asked this is because the expectation when GST came about was that in companies in industries such as yours will naturally benefit from the move from unorganized to organized. Is it taking a lot more time than what you anticipated?
Sure. Well, you could say that actually, so really we don't see a huge impact of GST at the moment. Yes, the GST rates have been at 18%, which has narrowed down the price gap between us and the unorganized players. But at the same time, demand's been a bit weak. So really, the benefits of GST, is not directly visible at this moment. But yes, I think over a slightly more mid-term to long-term basis, we will see benefits of GST. With the e-way bill also being introduced in this quarter, we hope that will also add to more compliances by the unorganized players, which will add to hopefully better profitability and top line for companies like us.
I had a cooling solutions company promoter, Saurabh, telling me that the number 2 market at least in that industry is thriving. It has not gone down at all. Is that the same case in your industry?
Right. I'm not sure on that, So really, I think the overall demand's been also weak from the building material sector. So I'm not really sure on whether the unorganized industry is thriving. So really, I don't want to comment, on something which I'm really not too clear on. Yeah.
So let's talk about how FY19 could turn out for you. 1, volumes, 2, realizations, and the operational picture as well, because you mentioned that costs came up as well, which impacted margins. How would all of these 3 things pan out in FY19?
Sure. So I think FY19, in FY18, we looked at a 10-12% kind of growth, despite the GST, disruption, the disruption in a couple of months before the year. We ended up with a 8.5-9%. top line growth. So I think in FY19 too, seeing the overall market scenario, we should be at a 10-12% kind of a top line growth. Obviously, the efforts will be there to improve margins, but yes, there are raw material cost pressures due to the crude going up, and 1/3 of our raw material cost is related to chemicals. And although we have passed on some price increases to the market, and some is yet to be passed on, so we are quite positive for FY19, from a perspective of building up the business. But yes, the challenges still remain, and that really depend on the team and us on how we can handle that.
Share some numbers, some internal targets, top line, margins, bottom line.
Well, tough to give you all of that, but if you look at our numbers of the last 3 years, each year we've grown profitably, we've grown EBITDA, we've grown top line, we've improved the balance sheet, the return ratios have improved, the working capital cycles have improved. We've not compromised on the working capital cycles in order to get more sales. So really, so we are trying to build a disciplined and a high quality business, and I think that direction will continue into FY19 also.
Would it translate? I mean, I don't want exact numbers, but do you reckon higher single digits or lower double digits growth is a possibility?
Well, I think like I said, in top line, we'd probably look at a 10-12% kind of revenue growth, and obviously that should translate to higher, better profitability at the EBITDA level and at the PAT level. Our expenses are largely under control from an operational perspective. Most of the capex has already been done. Working capital cycles have been managed quite well. So really, if you're able to get the top line, I think it should result in improving the EBITDA and the profitability.
Okay, one last question. Your debt levels came off in FY18 compared to FY17. What's the trajectory there? Or are you comfortable at the current levels?
Right. Well, if you see, last 2 years, we've been able to reduce debt by nearly 175 crores. And, in spite of the fact that we increased top line, like I said earlier, we've been quite disciplined with our working capital management. Our capital employed has hardly increased, so ready for the incremental sales, we've hardly put in more capital into the business. And I think if you're able to run the business the same way, which I think we should be able to, so we should be able to reduce more debt this year too.
Okay, we wish you all the best.
And we don't have major capex lined up, as of now. Yeah.
Okay. Saurabh, we wish you all the best for that and more. Thank you so much for taking the time out, and all the best for FY19.